Hello and welcome to Living Wealthy Radio. This is Kristin Colca, Bank on Yourself Authorized Advisor with Living Wealthy Financial Group. And this is part of a series of episodes that we are doing with Living Wealthy Radio, talking about Bank on Yourself and the infinite banking concept. And today's topic is how you can use your own policy as a line of credit. And of course, I'm joined by Teresa Kuhn. Welcome to the call, Teresa.
Thank you so much, Kristin. I'm excited we are doing this series, and I'm so excited to talk about using your policy, and that is, of course, your Bank on Yourself structured policy, also known as an infinite banking concept structured policy. And so it's using your policy as your own line of credit, one of my favorite topics in the world of financial strategy we work with.
Well, awesome. And so, Teresa, let's start the call off today with some definitions. So talk a little bit about what exactly is a line of credit.
So a line of credit is essentially money on demand offered by financial institutions. In layman's terms, how people relate to a line of credit, it's either they've got access to the equity in their home, through a home equity line of credit, or from a business owner's perspective, it's a line of credit that the bank gives them if they qualify based on jumping a bunch of hoops, including quarterly financial statements and proving to the bank that they are credit worthy, so that they've got that money available to them in reserve if they need to buy equipment or they need to take advantage of an opportunity in terms of, filling up their inventory or buying real estate or whatever it is that they need. And so it's, a set amount of money. And let's say if it's a home equity line of credit, you've got $300,000 of equity, the bank might be willing to give you an additional $200,000 in terms of a line of credit. And business, same thing. They'll allocate a certain amount for your line of credit. And instead of taking it as a lump sum, you can borrow it when you need it and you can pay it off. There are different repayment terms in terms of how you pay it off. You don't pay interest unless you use it. And typically the interest rate is variable. And once you do borrow against it, there is a draw period in which you make minimal payments or interest-only payments. And once that draw period ends, you enter what's called a repayment period. And in the repayment period, you must pay back the loan over a set period of time. So that's the, layman's and more of the technical understanding of lines of credit.
Absolutely. And I know that there's a lot of advantages to using a line of credit, which is why it's popular amongst individuals, families, business owners. And so what are some of the advantages of using a line of credit?
Well, the traditional line of credit advantage would be it's flexible. It allows you to deal with occasional cash flow issues, take advantage of the opportunities as they come up. If you've got an inventory type of business, you don't have to have all the reserves in place, the cash in place. If you've got an opportunity to, fill up your inventory, you can depend on the line of credit as, your backup. And lines of credit, especially for like real estate investors, can be less expensive than other types of financing. There's hard money lending, which most real estate investors are very familiar with. They're either lenders or they borrow money from a hard money lender. And that rate of interest tends to be anywhere between 12 and 18%. And so a line of credit would be a lot less expensive. And it's convenient. It's, literally like a line of credit. You can sign on to your bank account online and transfer money from one account to the other, or, get a check. And so very, very convenient from that perspective.
Right, absolutely. But just like any kind of debt or source of financing, there's also disadvantages to that, right? And so what are some of the disadvantages specific to using that line of credit?
Well, the payments can be unpredictable, right? If you tap into the line of credit and you get a bill for an amount that you're supposed to pay back, you may not be expecting that you had to pay back that amount, right? And sometimes it's an interest only, so it can be that variable, that flexibility can bite you in the butt, so to speak, if you're not ready for it. From a business line of credit perspective, it can be very, very difficult to not only get the line of credit, but to keep the line of credit. We have clients who have a designated employee that what they do on a regular basis is spend hours and hours and hours compiling the financial documents to prove to the bank that the business is still credit worthy, and in order to keep that line of credit open. And so that's quite of an investment or an expense, so to speak, to keep a line of credit open. It does take a lot of work. You have to constantly prove that you are credit worthy, and the lender sets and can change the rules for the line of credit. I often joke with my clients and say, when you got your line of credit, or when you got your home equity line of credit and you sat down and signed all the paperwork, did you read the paperwork? Did you read the terms and conditions? Or did you have your attorney review the documents? And most of the time, the answer is, of course not. No way, right? Just think back when you bought a home and you signed all those documents. You're not going to sit there and read it. And if you did read it and you had an objection to a phrase or a paragraph or a subsection, you're not going to go back to the lender and say, take that section off. I disagree with that. Or let's negotiate on some of these terms, right? It's not going to happen. And basically, the lender is absolutely and completely in control. Now, the biggest disadvantage, the lender can shut down the line of credit at any time. And I think the next slide is going to talk about that.
Right, absolutely. And we saw this happen with our clients quite often in 2008 and 2009. And so the next slide here is some pretty scary headlines that we saw in 2008 and 2009. And so, Teresa, what were some of the scenarios that our clients were facing when it came to the banks actually calling in their line of credit? How did that affect them and their ability to manage their expenses or run their business?
They were shocked. They were caught off guard completely. Because if you bank or you manage your cash flow based on having a line of credit, it really is a fool's folly, right? You're setting yourself up for failure. Because when times are good, the banks extend credit. But when times get a bit tumultuous, the banks have in their fine print the ability to close a line of credit at any time without even notifying you, even if you are credit worthy, even if you've jumped through all their hoops, even if your credit is impeccable, it does not matter. They are the boss, they're in control. And so I had clients come to me in shock that their lines of credit were shut down and they were put on a repayment schedule that they weren't expecting. So if you manage your cash flow, or if you're thinking, I can tap into my line of credit, my home equity line of credit to send my kids to college, or I can tap into my business line of credit because you know what, I can see into the future and sales are great, revenues great, profits great, we're good. Financially, we're great. We can do this and the bank's going to love us, right? Beware, you are setting yourself up because if things change in the banking world like they did in 2008, 2009, 2010, you could be in for a big shock. But with our strategies, we do have an amazing solution. And of course, you already knew this because that's why you're listening, right? To Living Wealthy Radio.
Of course. So, Teresa, how can the listeners fire their banker, fire their bank, and become their own line of credit for business and personal expenses?
Well, it does take a little bit of planning, and it does take capitalizing or saving money in our specially structured cash value whole life insurance policy. So there is no free lunch, unfortunately. So It does take some planning and saving some of that money in the policy. But as you're going to learn in a few minutes, right? The benefits that you get in setting up the money inside of the specially designed policy, and we're just going to call it policy for now, right? Everybody knows we're talking about a bank on yourself structured policy or an infinite banking concept structured policy, our specially structured cash value whole life policy, which is a mouthful, right? We're just going to refer to as the policy, right? It's got all these things you can do with it. Every dollar inside your policy is going to work harder for you than probably any other safe money strategy out there. But from a credit line perspective, from day one, you can borrow against the cash value. And on day one, you can pay back that loan on your own terms. You become, so to speak, quotation marks, the banker. We're not setting up a bank. We're not saying that at all. We're saying that you can use your policy to fund your cash flow, expenses, whatever you need, right? Business and personal, just like you would a line of credit. But there are some differences.
Right. There's some big differences between a traditional line of credit and a bank on yourself or infinite banking policy loan. And Teresa, I think one of the biggest differences is the collateral. So can you talk a little bit about the collateral and what happens to that collateral if you are not able to make payments back to that loan?
Well, just like the collateral of your home, right? If you take out a traditional home equity line of credit, your home is your collateral, right? And so if you can't make your payments, then you're subject to a foreclosure and there goes your house. With the policy, the collateral, the insurance company is lending you the money and using the death benefit on the policy as your collateral. And what happens with that death benefit is if you die anytime with that loan outstanding, the insurance company is going to pay your beneficiary the death benefit minus the outstanding loan balance. And so your family still gets to benefit from the death benefit in the policy.
Absolutely. And if you can't make your payments, you still have your home to live in, right?
That you do. You still have your home to live in. It's just your policy, you know, and I will put, you know, the asterisk right next to, you know, this little disclaimer here. You do need to manage the loan in your policy. If you think you're going to take out loans and never pay it back or never, you know, manage the policy loan, you could lose your policy. So it's not like you can take out loans and never replenish or never pay back or never pay another dollar in premium and your policy is going to be okay. That's not the case. We're not suggesting that at all. But properly managed loan inside your policy gives you a lot more freedom and a lot more security than putting up your home for collateral, or putting up your accounts receivable in your business, or capital equipment, right, that you need to run your business. If you don't pay back the line of credit and that's what you put up for collateral, you may be out of business if you can't make your payments because the bank's going to come and collect.
Right. And as Nelson Nash, the great Nelson Nash would say, don't steal peas from your grocery store, right? So we know with a traditional line of credit, you do have to qualify based on your net worth, your income, your credit score. How do you qualify to take a loan from your policy?
You ask for it. That's it. You make a request, and as long as you've got cash value in your policy, you can borrow anywhere between 85 and 90%, sometimes 93%, but we like to underpromise, overdeliver. So whatever your cash value is, there is a loan value, and that's the value that you can borrow. And you can take as many loans as you want. You can take a loan out today, a loan out next week, next month, next year, multiple loans. As long as it does not exceed the loan value, you can take those loans out.
Got it. Absolutely. And I think the most interesting things too about taking a loan from your policy is the interest, right? Because one of the objections that we hear quite often, Teresa, is that, well, I'm being charged interest to borrow money from my policy, and I'm really borrowing my own money, right? But that's not necessarily true. And the way that the interest compounds inside the policy is very different from a traditional loan. So can you speak to the differences there in terms of how that loan actually works inside the policy?
So we'll speak conceptually, and then we'll refer the listener, if they want more information as to exactly how the interest works inside the loans, to contact us directly so we could explain this further. But basically, the insurance company, the way I like to explain it is you've got two ledgers. The insurance company has two ledgers, right? When it comes to your policy, they've got one ledger that calculates an increase in cash value, which means, dividends being paid into the policy and how much your policy is growing every single year. And of course, death benefit. And then on the other hand, there's another ledger. When you take out a loan from your policy, you're actually borrowing money from the investment pool of the insurance company. And so that's another ledger from which they are charging you interest for that loan. So on the one hand, you're being charged interest. That interest gets paid back to the insurance company. On the other hand, because we use non-direct recognition policies, the insurance company is still crediting your policy as if you had not taken out a loan, the full value. So your dollar is working overtime. If you've taken out a loan, it's working in the investment or the capital equipment or whatever else, whatever reason you borrowed that money out, plus it's working for you in your policy, because your policy is growing as if you had not taken out that loan. Now, when it comes to your interest expense, I want you to understand it really is probably the most efficient loan and loan interest you will ever have in the loan world out there, right? It's a much more efficient loan. And again, without getting too complicated in the details, if you've got questions about it, come and reach out to us and we will explain it in further detail.
Perfect. Absolutely. So, Teresa, to illustrate this whole concept of using your policy as your own line of credit, we have a case study to look at today. And this is an actual client of ours. It's a 45-year-old. He's a real estate investor. He finds and flips houses. And he really wanted to have access to a $500,000 line of credit to use for financing expenses while he's remodeling these homes. So paying for contractors, etc. So how did he fund his policy to create his own line of credit outside of the banking system?
Okay, well, basically, he capitalized the policy to start, and he had $150,000 to do this over 4 years. And I know for some people that sounds like big numbers, and I want you to think you could do this, $15,000 a year, $50,000 a year, $500,000 a year, or more. So it's the concept I want you to grasp, not the, oh, I can never do that, right? He did $150,000 a year for 4 years, and assuming that he continues to pay into the policy $30,000 until he turns 65, so a total of 20 years, the numbers we're going to share with you is how these numbers are projected based on $150,000 per year for 4 years plus $30,000 a year until he turns 65. And what this gave him is, instead of a line of credit, through his bank, he had the access to cash and the flexibility to pay back the loans on his schedule, meaning either interest only, or as he flipped houses, paying it back into the policy, or not at all for a period of time. This is where he's the boss, right? He's in charge of how he pays back his loan.
All right. So, Teresa, what were the results of doing that? So he put $150,000 into his policy for 4 years. Then he put another $30,000 in until he was 65. So what were the results? What, in numbers terms, what did he have inside his policy?
Well, the first year he had $115,000 loan value available, and he created a death benefit, really an asset, which the insurance policy, cash value life insurance, is an asset of $3.7 million. I'm going to go ahead and just round the numbers to make it easier to speak, right? And then by year 4, he had grown his cash value to over $562,000, and his goal was to have a line of credit of $500,000. And so the loan value after year 4 was over $500,000. We accomplished that goal, right? And so he chose to want to continue, or at least projection perspective, to continue to pay $30,000 into the policy over the next 20 years. And so by the 10th year, he had over $930,000 in cash value. Remember, every dollar in his policy, from a loan value perspective, it's not like it's stuck in his policy and he can't do anything with it. He can borrow the money in his policy and use it for the real estate, pay it back, use it for the real estate, and he's double dipping. The money in the policy is still growing for him, right? By the time he was 65 years old, he has over $1.8 million of cash value and $4 million of death benefit. I want to go back with one thing, though. I said he could use the money, loan value, for his real estate. But even though his objective when he started the policy was for real estate, in the meantime, if he's got kids that he's got to pay college for, if he's got renovations that he wants to make in his house, if he's got a buddy who's got a really cool idea that he wants to invest with, if he wants to take a year off and take the kids and the wife around the world, right, and borrow money from his policy, he can absolutely do that. It's not this policy is designated for real estate and that's all I can do with it. Absolutely not. The intention was for real estate, but the cash is in there to be used for whatever he wants. And the tax status of the interest that he's paying, if it's used for investment purposes, he can write that interest off. Right? So it doesn't have to be set up that it's just for real estate. It's set up where this is cash that I've got that's available to you for whatever you need or want. And then by the time, in this example, in this case study, by the time he's 65 years old, that $1.8 million can be used to supplement retirement. And if he chooses to do that, he can take $85,000 each year, income tax favored. The disclaimer there, the asterisk there is, if he takes out the money the way we advise him to take it, he will not be triggering a taxable event, and that's $85,000 income tax free. So at age 85, he will have taken over $1.7 million in income from the policy, still have $940,000 of cash value, and still a $1.1 million death benefit. And all along this time, if he had a chronic medical condition, a critical medical condition, or a terminal illness, he could have accessed the death benefit while he was living, accelerate that death benefit to benefit him for whatever reason. And it's not a kind of benefit that you have to prove these are my medical expenses. He could use it for anything he wants, anywhere in the world that he wants to. Kristin, what do you know? What other strategy do you know from a safe money perspective that a dollar can work as hard, right, and have as much flexibility as a dollar does inside of this policy?
Right. There isn't one, and that's why Pamela Yellen has her $100,000 challenge, right? She's challenged us to find another financial vehicle out there that does all of these things, and no one has been able to yet. And that's the most beautiful thing about these policies is it's not either or, it's and you have access to your cash value, and you have the death benefit, and you can self-finance these things, and you can invest, and you can pay for college, and you also have some benefits there if you're chronically ill or suffer a terminal illness. There's so many things built into the policy, and it really gives you just tons and tons and tons of options.
That's right. And you know, that challenge is a great point that you bring up. I think that challenge has been out there for at least 10 years. She's never, ever paid on it because no one's been able to come up with a strategy that beats Bank on Yourself structured policy.
Absolutely. So, Teresa, if our listeners or our viewers out there want to know more about Bank on Yourself or the infinite banking concept, or how to set up their own lines of credit inside their policies, how can they reach out to us for more help?
Well, they can reach out to livingwealthyfinancial.com. They can email us at info@livingwealthyfinancial.com. I think it's posted info@livingwealthyfinancialgroup.com. It will find us. They can call us direct at 800-382-0830 and schedule a free, no obligation analysis to find out if a Bank on Yourself infinite banking structured policy can help you accomplish your goals and objectives. And even if you don't think so, or you just have questions, you want to pick our brain, you've got a policy. If you've got a policy and you think it's a Bank on Yourself structured type of policy and you want a second opinion, we are happy to do that. We are here to help you. This concept is not for everybody, but it is for a lot of people. And, we're here to help answer questions and serve you.
We sure are. And thank you so much to everyone for joining us today. We appreciate your time. We appreciate your attention. And we'll talk to you next time. Thanks, Teresa.
Absolutely. Thank you, Kristin.